People are starting to realize CPAs, you're not just an auditor, Marc was saying, like you're a business advisor. There's a lot of businesses that are being run by people that are close to retirement and nobody to take over these businesses.
They have made a number of changes to taxation that has directly affected small business owners, which once again is the lifeblood that drives the Canadian economy.
And the taxpayer on the initial structure of setting up your business is critical to any small business owner.
All right, Marc and Matthew of the newly formed, is it Durco or Durante Colasanti?
The legal name is Durante Colasanti LLP, but
I
Durco
like Durco
for short.
better. I like Durco better. Okay, so you guys recently formed your new accounting firm, but you've been at it for how many years now?
Close to 10.
Close to 10, but on your own though?
On our own, it's been 5.
And so when you first started out, did you realize that you were going to work about 65 hours a week, every single week for the rest of your life, or no?
We had a feeling, but we didn't know it'd be like this. But I mean, it's a good 65 hours, though. It's a fun 65 hours.
I don't know about that, but okay. So the first thing I want to talk about with you guys is really the shortage of CPAs, or the shortage of accountants and quality back office workers in our industry. I don't know where it's coming from. It's probably started over the last 20, 25 years. I would say when I started about almost 25 years ago, there was a huge shortage. Are you guys noticing this at your end?
Yeah, I think it's something that has been a problem now across the industry for a lot of years. And I think one thing that I do, so not only do we do public practice, so we're a 3-partner firm located in Vaughan. So just a little bit of introduction. So I do the assurance practice, Matthew does the tax and estate planning, and then our other partner does the accounting and advisory role. And where I noticed the shortage mainly is part-time. I teach at York University at the Schuler School of Business, and I teach first-year students. And I always like to ask the question, because first year is like introduction to accounting. So they're not specialized yet, right? This is their first accounting course that they're taking. So I always like to gauge my class to see who has an interest in accounting right from the entrance of university. So I always ask the question, who here wants to be a CPA? And when I started teaching, which was about 5 years ago, about 50% of the class would raise their hand, even a little more than 50%. And Schuler School of Business was predominantly an accounting school, I would say. That's changed over the years. But up until recently, when I would ask my class, who here wants to become a CPA, I think it was as low as less than 25% in the last 1 to 2 years would raise their hand. So I think there has been a shift away.
Before, it used to be like 80% of the kids would put their hand up.
Oh yeah,
for sure. Like that's what Schuler was, predominantly like an accounting school. But accounting isn't sometimes it's not the most glamorous career. People think just, accounting, it's like you're doing your debits and credits. You know what I mean? It's different. Like we run like a small firm type practice, and similar to yourself, right? You're dealing with a bunch of different issues every single day. We even do some CFO level advisory stuff. We do all kinds of stuff. So it's like we offer that. Like it's not like you're just going to be doing auditing at our firm, at your firm. You know what I mean? You do auditing, you're doing accounting, you're doing tax, it's almost like a rotational program where you're dealing with different stuff every day as part of being in a small firm. So it's a little different where you're not actually a part of one specific industry or one specific kind of the area of work that you're in. So it's a little different.
I want to put this into a little bit of context, right? You guys are running your own small business focused accounting firm, right? And when you look at the Canadian economy, when you look at the way that the Canadian economy is structured, small business, you can define it however you want. The government defines it as a business with less than 100 employees. I think that, if I'm not mistaken, it's something like 50% of the workforce, of the private workforce in the Canadian economy is generated or employed by small business. And when you have a situation like this where nobody wants to get into the profession to support these small businesses, and you have additional complexities, whether it be for financial reporting, for tax reporting, for tax compliance, right? I think that you're getting a problem that is going to be systemic across the entire economy, right? I'm seeing this problem. I'm for sure seeing this problem. I can't find anybody any good quality workers. You guys can't find any good quality workers. You're in at ground zero, like accounting 101. What do you think can be done about this?
So it's a very good question. It's a very good point you make. And I think there's been the wrong perception of accounting over the years. Everyone who you always ask about accounting is, oh, you want to become a CPA. And I've heard this from the university level, college level, all the way even to like the entry level of a staff. A lot of individuals think that the CPA designation is too hard to obtain, which it's not easy to obtain, but obviously if you work hard and if you have proper work ethic, you can obtain it, especially if accounting is something that comes naturally to you or whatnot. And the other factor is that I think that a lot of times students and staff level accountants, they fall into the trap thinking that accounting is just audit. And we hear that a lot when we're hiring, going through recruitment. We think, oh, I don't want to do audit. I don't want to work 80 hours a week. I don't want to do it. That's boring. I want to do something more exciting. Where in the small firm, mid-sized firm environment, you do a little bit of everything, as you're saying, right? In a small firm practice, you're almost like a business advisor to your client. So yes, there is going to be potentially an auditing component. There's going to be a financial accounting component, but then you also get that advisory level CFO type work that maybe you wouldn't see so much in a bigger firm environment.
Yeah.
So it's just when I teach my courses and I'm talking to my students, and I get it all the time, people reaching out on LinkedIn, students want to have a coffee chats, they want to understand about the industry. I'm not saying there's nothing wrong with the big firm, but it's just showing options out there as you obtain a CPA designation.
Yeah, and early on accountants, like they think, okay, your first entry in is different now. It's not like it used to be before where you had to go work at a big four accounting firm and you had to do your hours in order to get your CPA. You can do it in multiple different ways now, right? You can go work at Walmart in their accounting department, you can still get your CPA, right? So it's very different. But at the same time, it's like there was a big stigma before where it's okay, work at the big firms. You're going to put in 80-hour weeks instead of our 65-hour week, let's say. And then you're going to get paid lower than you would if you went to industry, worked at Walmart or worked at Bell or worked at Rogers or something. So there was that kind of like stigma towards long hours, less wages, and then you got to go through your 3-year training program to get out of it and get your CPA, whereas it's different now. And there was like a trend and a change in the way kind of the salaries have worked for CPAs, especially the entry level. Like we found there's been a big jump over the last, I don't know what, five or so years, let's say, like a considerable jump to get people more attracted into accounting, whereas before it was very low wages and you're doing a lot of hours. If you actually calculate like your hourly rate, you're not making much anyway, right? So there's that impact of it, but it's catching up. People are starting to realize CPAs, you're not just an auditor, Marc was saying, like you're a business advisor. Like you even see with us, so we're part of a small firm network, let's say, and it's okay, oh, my client, maybe he needs life insurance. Maybe there's like some tax planning we got to do. Oh, maybe I'll call Fabio. I'll call Matt. You know what I mean? Like we all work together to help service our clients, and we can make sure we have specialists in the space that are very like knowledgeable in that certain area. So it's a cool industry.
I would say, especially from our perspective, small business advisory, small business accounting, small business tax advisory. You guys know Dave Ramsey? Anyways, he's like a super popular best-selling author on personal finance. And he did a massive, I may be butchering the stats here, but he did a massive sort of study on millionaires, like people who became millionaires out of their own right that didn't inherit the money, let's say. They took all these questionnaires, took all this data in, and what he found was that the second most frequent millionaire, and they did something like 10,000 interviews, the second most frequent millionaire above doctors, above dentists, was actually CPAs. He has his own theories on why CPAs eventually become very wealthy. And he links it over to the number one, which is engineers, right? And it's not about what they earn. It's about the way that they follow processes, right? Yeah. They follow step 1, step 2, step 3. I look at it a little bit different. And this is what I tell like a lot of young people that want to get into the profession, or maybe they're looking at law, maybe they're looking at something, something else, right? When you're looking at a CPA, especially a small business CPA, you're pretty much the most frequently contacted advisor that individual will have. And if you are working at a successful firm, just a random small firm that no one's ever heard of, but that's successful, that has a good client base, you're dealing with a crap ton of multimillionaires. And a lot of the times these are self-made multimillionaires. So you're talking to these people, you're getting to know them, their family, all the mistakes that they've made. You, through like osmosis, I don't know what the word would be, but you absorb what they've done and you learn vicariously through them. And I think it's that learning that you do through so many different clients translates over to the CPA making a lot of money eventually, like when you look at it from the long game perspective, they were like, hey, listen, CPAs and engineers, they end up the wealthiest out of everybody. So I think it's that combination of, the financial education, but also your exposure to people that are good with money and bad with money where you can learn. And I'm sure you guys are seeing that. You guys have all kinds of crazy rich clients, right?
Yeah. Even in the industry right now, it's like there's going to be a major shift too, like between a lot of baby boomers retiring and passing on their businesses. I don't know what the stat is, but there's a lot of businesses that are being run by people that are close to retirement and nobody to take over these businesses. Or there's a great wealth transfer from the baby boomers to the next generation where you're going to be assuming all this wealth and have really no idea how to do with it, or the parents were dealing with it before. And it's okay, where do I start? And honestly, a good person to start with is your CPA, or go talk to your accountant, because your accountant is like your most trusted advisor and really understands your entire business more than almost sometimes you might not even understand your business. So it's good to talk to them. It's good to have a CPA on staff or with you working like as your external CPA, because they're the ones that are in tune with all the changes. Like even we'll talk about it later, but there's a bunch of capital gains tax changes. There's all kinds of things that are happening on a daily basis that the government's just throwing into us and they don't even know what they're doing. If they don't know what they're doing and they're passing it on to us, it's almost, there's just this big kerfuffle of what's going on. So if we don't even understand it, sometimes the CPAs and the government doesn't even understand it, imagine your client understanding it, or you as the business owner, it's just like, where do I go next? And we even saw that through COVID and whatnot too. It was like, there's all these changes and there's a lot of incentives for businesses. And like, how do you even capture those incentives if you don't even know about them? And your accountant's your perfect person to ask, like, how do I navigate through these changes?
No, I'm sure same thing happened with you guys during COVID, during that first initial wave, right, where everything was shut down. Everybody's panicking, and I was constantly on the phone with my clients, right? So you got to imagine, I don't probably 1,000 clients. So everybody was ringing my phone off. Everybody was ringing my staff's phone off.
You're the go-to at that
It was
point.
crazy. They're asking me the question. I don't fucking know. That would be the same boat as you. But that's the whole point, is that you become the primary advisor to the.
You're their
to the
partner.
client.
You're their partner in their
Exactly.
business, right?
Exactly.
So,
But this, I do want to swing over to this, because you brought up this point that you wanted to talk about the new capital gains rules. I want to outline, I'm politically neutral. I could care less. I hate all politicians. I think they're all scumbags. But this particular government, the Liberal government that has come in, they have made a number of changes to taxation that has directly affected small business owners, which once again is the lifeblood that drives the Canadian economy. I want to emphasize that. Small business is the lifeblood for the Canadian. It's literally the backbone of the Canadian economy. All right. Now, they've made a number of changes that affect small business owners, real estate investors for sure. And I would want to say that it started with probably around 2016, when they started
TOSI?
Not TOSI. First, it was the disclosure of the disposition of your principal residence.
Yeah.
Whereas there was administratively, you never had to report the sale of your primary home because it was tax-free. So now they started saying, okay, yeah, it's tax-free, but it's technically a capital gain and you have to report it and give us the information on it. Okay, what's going on here? If it's tax-free, why are they willingly putting more work on the plates of the already overworked CRA? Okay, maybe they want to gather data, right? Then we get to TOSI, or the tax on split income, where they essentially said, hey, listen, you can't split income however you want amongst family members from your small business. Whereas back in the day, we used to just income split mom, dad, grandma,
kids.
grandpa, kids,
Yeah.
dog, cat, everybody. I used to split income. That was my basic go-to tax plan.
Yeah.
Just split income with everybody. Okay, they got rid of that. Right? Then they introduced a bunch of other measures, and it culminated in this year, the new proposed legislation whereby they increased the capital gains inclusion rate.
Yeah.
So to give a little bit of background on that, capital gains, the inclusion rate for capital gains has changed many times over the years. But for a very long time, a capital gain was considered half taxable. Okay. So I explain this always to people like, okay, you have a tree and it's an apple tree. You plant it, you grow apples, pick apples, sell the apples. That's a business. You're in the business of selling apples. Then when you're about to retire, you're like, shit, I don't want to do this anymore. I don't want to pick apples and sell apples. You sell the tree to someone else. Selling that tree is not your primary business. You just had that tree as a capital asset. Therefore, if you made a gain on selling that tree, the government gives you a break and they say, I'm going to tax only half of that gain. Okay. That's what a capital gain is. That's how I explain it to someone who's a non-financial professional. All right. So the government has come in this year and essentially rewritten the legislation and said, oh, if you're rich, and we define rich as you have a capital gain of $250,000 or more, we're not going to give you a 50% tax rate. We're going to make you include 2/3. Or if you have a trust or a corporation, you must be rich. Therefore, the entire capital gain is going to come in at 2/3. All right. I want your theories on why this was done. Okay. Obviously, it's a money grab, but I'll give you my theory as well. Go ahead.
Yeah, it's a good point. To get even into that too, it's to make it even more complicated is they came through with these changes in the budget, I think last year around April, and they're still not even in place. So it needs to pass up through, it needs to get into legislation, and it hasn't even passed all the way through to legislation. Accountants and whatnot, we're still acting as if it passed after June 25th.
I'm not taking any chances.
Exactly. So we're operating with that any capital gain after June 25th, 2024 is considered to be 2/3, or use the exemption like you're mentioning of $250,000 for an individual. So yeah, good point. They mentioned that this is only going to affect 1% of Canadians.
And that's what I want to get back to. Yeah.
And we'll get back to that, but that's crazy. This doesn't impact just 1% of Canadians. It impacts somebody who dies, someone who has a rental property, someone who has a cottage. And we're talking, if that's only 1% of Canadians, it's just a complete lie. It literally completely impacts well more than 1% of Canadians. And it's a big issue. So yeah, to get onto that, I mean, they're changing that capital gains rate from 50% to 2/3, and it's going to have, they say it's going to have a significant impact on revenue generation for taxes for Canada, but it's essentially a money grab. Yeah, it's a good point.
Yeah, I mean, if you're a real estate investor or a small business owner and you're not informed on this tax change and you're not pissed about this change, I don't know what the hell you're doing, because this is going to definitely affect you. And it's not going to affect 1% of the population. It's clearly going to affect more. Yeah. And what I like to say about this is they give you a $250,000 exemption. Is that going to be increased over the years by inflation? Yes or no? Because if you were to buy a property right now for $1 million, I need you guys are good at math. You got to do this math quick with me. You buy a property right now in the GTA for $1 million. Since 1975 or 78, I think it was, GTA properties have gone up by about 7% per year, compound, right? You do the math quick, that's every 10 years, they double in value. So $1 million right now, you're 40 years old, okay? In 40 years, it's going to go 2 million, 4 million, 8 million, 16 million, let's say, by the time you sell. That $250,000 exemption is fucking meaningless to you. It's meaningless.
It works out to being like
nothing.
It's
nothing.
Yeah.
So you're basically, what's going to happen is that property that you bought for $1 million that you're going to have a deemed disposition on at death for $30 million, $40 million, pretty much 2/3 of that is going to be taxable. How's your estate going to pay that tax? It's impossible. It's impossible. So it's a clear money grab on the baby boomers, because all the pregnant capital gains that they've had in their rental properties, in their businesses, in their stock portfolios, they know these guys are going to die because, well, what's the only guarantee in life is death, right? And they're hammering them now. Yeah. So all the tax planning has to change. It all gets thrown into our pockets, which you would think would be a blessing to us, because then we're going to be able to charge fees to figure it out. But it brings us back to the old problem that we don't have any fucking accountants to do any of the work.
Yeah, yin and yang, yeah.
Like, so, I think when we talked about the principal residence exemption coming into place, the reporting of it in 2016, where I understand why they did that, because you had people abusing the system and abusing the spirit of the act of what that was put in place for. Yeah. Because you had people claiming multiple principal residence exemptions per year, and that's why they wanted to report on it. Fine, I get that. You don't want people to abuse it. Fine. But now with the inclusion rate increasing on the capital gains rate, it's almost like, obviously real estate has been the highest appreciating asset, or I don't know, you can fact check me on this one.
Canada's best industry. Yeah.
It's Canada's best industry over the last 50 years, let's just say, right? So it's like all of these individuals who invested in real estate and took that risk Because 30, 40 years ago, people were buying real estate. Maybe they were looked at as crazy, or what are you doing? Why are you putting this much money into real estate? And they're sitting on all this real estate today. Now it's the government's coming after you and saying, actually, instead of taking 50% of that, I want 2/3 of that. And I think it's a little unfair to that individual. Would you not agree?
No, it makes sense. And we're doing a lot of tax planning for our clients right now. And that's the number one thing you should take a look at before year end is you should do some planning around this $250,000 exemption. So it actually works out to being like about $20,000 to $22,000 in your pocket if you actually utilize that $250,000 each year, and or even spread it across your family, let's say. So we're doing a lot of planning around that. And even with your stock portfolios, right? If you're an individual with your stock portfolio, come year end, you're going to want to take a look at, hey, can I sell? If I'm selling, let's try and plan to have around $250,000 of capital gains that I can control it, utilize some of your capital losses and whatnot. That's some planning you can do. We're even seeing that it's like now in a corporation, Fabio, you mentioned too, with this new 2/3 like inclusion rate, corporations are fully at 2/3. There's no $250,000 exemption.
This might be a little bit technical, but I'm saying, okay, if they're going to make inclusion rate 2/3, and I have a group of people that want to, I don't know, buy a 5-plex, a 10-plex, or some sort of an apartment building, or some sort of asset that they want to hold for a long period of time, have it appreciate over a long period of time. I'm not going to use a corporation, but I still want the limitation of liability. How about I use a limited partnership instead? Are they going to though then subsequently change the rules to include limited partnerships? Because the limited partnerships become a popular way to structure deals, right? So I guess but this is nothing new. This is with tax planning.
It's always changing.
Us versus them, right? And I always tell people, I say, listen, the smarter guys are not working for the government. The smarter guys are working in industry. They're working in the big law firms. They're working in the big accounting firms, and it trickles down over to the smaller accounting firms, the smaller law firms. So we're probably always going to be ahead of the curve when it comes to tax planning and working within the rules to give the best advice or the best possible outcome to the client. But with this particular government, and once again, it's not like I'm new to this. I've been doing this for almost 25 years, right? This particular government has made it a bit of a reporting nightmare, and they made it a little bit overly complex, I think, for themselves, because I'm seeing the symptom in lack of ability to contact and get answers from the CRA. I'm seeing that symptom. They're not following up on things. So I think that they've just created a little bit of a mess. I don't know if the next government's going to clean this up or if they're just going to inherit this mess and kind of deal with it. I don't know what you guys are seeing.
We saw with the, the trust reporting and the UHC reporting.
Yeah.
They put this on accounting firms, and it was a big influx of work, but a lot of stress on your clients and yourselves, increased in fees. And then when it's like the last hour, they pretty much said you don't need to report it.
I think it was I think the Bear Trust reporting was due March 31st last year. And come March 30th or March 31st, they're like, okay, we're going to delay it, and it's not going to be applicable for this year. So
To put this into context, for people who don't understand what that is, a Bear Trust is an informal agreement, right? So let's say, Mark, I give you some money or whatever, or you have some money, you buy an asset, a house, right? In trust for me, right? So we don't go to a lawyer and settle a trust. It's just an agreement. You're holding this asset for me, okay? Oh, and it's very simple. 1-page document if you actually document it. You never had to report that. Ever. I would just report that property if it generated income on my own tax return. That's it. So obviously there's abuse of this type of situation where criminals will hand cash to someone who's clean. That clean person will buy an asset, usually a piece of property, and hold it in trust for someone else. That never had to be reported to anyone. It was a private document. It was a private agreement, right? So the government then decided, hey, we want to know about these things, all right? And we're under a self-reporting system. So this is where I'm confused about what they think that they're getting at here. We're under a self-reporting system. So they're like, okay, we're going to mandate that you must report these arrangements, all right? Do you think criminals are actually going to fucking report this?
No, you're overcomplicating the system. And it's like you get clients coming to you and it's just too complicated for them to comprehend. And making the system too complicated is just making it even more non-compliant. It's who's gonna understand these rules if they're constantly changing. And now you're making it on even just the normal taxpayer who just files a personal tax return. I got to report all these obligations, and it's who's going to do this for me? And then you have to get we have to charge them for it because it takes time to do the work.
And big
right?
penalties.
Yeah. And, it's big, and it was not small penalties.
So you have to file the underused housing tax. So if you have a property in trust for someone else, which so many families have, you have to file T3, underused housing, plus you have to report the income on your tax return. So one rental property, simple thing, could end up costing $2,000 a year to report. Easily. And if you don't do it, you're looking at $5,000-$10,000 of penalties.
Yeah.
And it was a
Annually.
big annually.
Annually.
It was a big strain we saw on like the sole practitioner, smaller accounting firms, because obviously this comes back to our original point, the shortage of CPAs. So a lot of these smaller accounting firms, sole practitioners, they don't have the proper resources to take on this influx of work that immediately, right? They don't have time to plan for it. Now that you have
Learn about it.
You know how many, I don't know the stat, how many sole practitioners who are probably thinking about retirement after the last year and a half probably said, forget this, I'm done with this. Because they couldn't take it anymore. And I don't blame them. Like at the end of the day, it's now on top of everything they have to deal with their year-end compliance and everything. Now you're adding this additional reporting. And then at the last complete hour, you're like, you never mind, you know what? You don't have to do this anymore.
Literally the last hour when you're ripping your hair out of your head. Like friggin'.
At least this year they came and said, okay, for 2024, you're not going to have to do it. We'll start mandating it later, but it's been crazy. And we're getting constant questions from clients. It's okay, do I have to do that trust reporting again this year? And it's no, you don't have to do it. And it's like, okay, well, why did I have to do it last year? So it's just constant. And then it's like, you're almost like, they almost don't trust their accountant in a sense. What now? It's okay, why is this changing? Is it you guys that's changing this all the time? And they're not educated enough to understand that it's the government we're dealing with right now that's going back and forth on certain things, right? So,
and then it looks bad on us.
And it looks bad on us too, right? Of course. But at the same time, it's important to be up to date with the rules, and we are up to date with the rules. And it's important for you as a business owner or a rental property owner or a real estate owner to just understand the obligations you have, right? It's complicated, but that's why it's ever more and more important to be in touch with your CPA. And then, because you never know, even especially if you have assets, there's taxes like your biggest expense sometimes. And most of the time, it's your biggest expense, right? Especially if you're a high income earner and you're being taxed at 50% as an individual. Like every dollar is taxed. 47 cents stays in your pocket, whereas 53 cents you're giving to the government. So it's like you got to be in tune with the regulations and the changes to kind of understand the tax savings that you can have. Because if you don't have a proper structure in place, you're just giving away money at this point to the government. And it's money that you can help keep yourself to help your business grow. Or even your kids, your family, and your estate, essentially. Yeah. And just stay on that capital gains topic. There's something we have in Canada, which is that lifetime capital gains exemption, right? And that's being impacted too by this 2/3 inclusion rate. Whereas they did go now, so the lifetime capital gains exemption, what it is, if you have an operating business and it's considered to be a Canadian business and whatnot, there's a little more rules around it. But at the end of the day, if you go and sell your operating business and it's a pure business, you can claim something called the lifetime capital gains exemption, which used to be roughly indexed to about $1 million. So when you actually went and sold that, factoring it from an individual perspective, you're about to save $250,000 in taxes by just utilizing your lifetime capital gains exemption. So that's been an important piece of tax savings in Canada for the last, I don't know how many years. And then now what they're doing is they increased it, they indexed it by another 250,000. So now it's about 1.25 million, which you can actually have a significant savings on if you sell your business. And that actually translates with the new 2/3 to being about 430,000 in tax savings now. That's
actually a good segue into what I wanted to ask you about in terms of business structuring. Right, for small business owners. So this is something, there are very few legal tax shelters in Canada, okay? The big one is the principal residence, right? So you don't get taxed on the sale of your home if you sell it at a gain, okay? There's some other obscure ones like flow-through shares, things like that. Then you have obviously RRSPs and TFSAs. Everybody knows about those. We could talk about life insurance if you want. Life insurance is a legal tax shelter. But one of the bigger legal tax shelters that, in my opinion, is not planned for and not utilized enough, especially with the dominance of small businesses in Canada, is the lifetime capital gains exemption. So the lifetime capital gains exemption, as you mentioned, when you take a qualified small business and you sell the shares of that business, if you meet all of the tests, and I'm not going to go through the tests because there's too many, but if you meet all the tests, you can save yourself per person, so husband and wife, let's say, kids, about $400,000 each in tax by selling your small business. This gives a huge incentive, in my opinion, for families to start a business, a small business, grow it, and then eventually package it up and sell it. But what we see, at least what I see, I'm sure you guys are seeing it as well, is no one's packaging the product to sell it properly.
Exactly.
And there's a number of different things that we could talk about, many of these things which none of us are qualified to speak about, like how to package it up to sell it for a better price, this, that, the other. But the packaging of the business to sell it tax-free and to obtain that legal tax shelter, that's what I want to get on. Because there's a fight between saving money for retirement through your small business and being able to sell your small business.
For sure.
Right? So why don't you guys give me a little bit of background on that?
So I'm not the tax guy at the firm.
Yeah,
so Matt's gonna Matt's gonna build on this, but you wouldn't believe, and this comes to your point of setting up that structure and just educating the taxpayer, the small business owner, on the lifetime capital gains exemption. Because countless times we'll have clients come to us or come to Matt and they're like, I want to sell my business. That's okay, great. They're like, I have an offer, $2 million for my shares. I want to sell it. And they're like, I heard about this tax-free shelter, blah, blah, blah. And then we sit down, the lifetime capital gains exemption, you got to be a pure business, small business corporation shares. We look at their books and they're offside and they don't qualify for this, for the capital gains exemption. And then you tell them that you won't be able to claim it if you sell your business because you're not pure, and then they freak out. So I think educating your clients and the taxpayer on the initial structure of setting up your business is critical to any small business owner. And at least just advising them, they don't have to do it because obviously there's more setup costs, but just advising the taxpayer and the small business owner on the initial setup is critical because when they do come to the point where they want to sell, at least they're properly set up.
Yeah, and you made a good point. You said he's offside. Like, what's the most common, I guess, way of being offside that you see on these companies, these qualified small businesses in Canada? Yeah, what's one?
It's you just got your holding company operating structure, and then your holding company, or you have your operating company owning passive assets. So it's you have an operating company where you own the shares, and in this operating company, all the excess cash, your retained earnings that you've built up over time. Well, it's okay, what am I going to do with this cash? I don't want to pull it out because then you got to pay tax at 53%, as we were mentioning before. So it's what do? Okay, let's go and invest it, in a piece of real estate, a passive asset. Let's go buy some equity stocks, right? Now you have an operating company that has passive investments, and that's what throws you offside.
Exactly. Yeah. So we see it all the time. And even with new clients, they'll come in, like Marc was saying, hey, I want to sell my business. And you go look at their business, they have an operating business, and they got a piece of real estate inside that's not related to the business, or they got a stock portfolio, and it's like, okay, now we got to do a reorganization to get this out. But there's obviously a lot of technical nuances when you get into that where it might complicate from even selling or doing this type of planning before a sale. So it's always very important to make sure that you have a structure from the very beginning. And that's something we always preach. Obviously, it costs a little more to set it up and have a certain structure in place. But if you just normally set up like your operating company and you earn income every single year and you have those profits just sitting in your company, and you have let's say you just keep it all in cash. That cash, for the most part, most of it, if it's just excess cash, is not considered to be an active asset. So you'll have yourself being offside when you try and go sell this thing and utilize like your lifetime capital gains exemption, which is like a one-time exemption. And if you ultimately go sell your company and you don't qualify for that, you're taking a hit of $400,000 for no reason. And so it's a big impact. And we do preach setting it up from the get-go. If you believe you're going to have a profitable business, which obviously you do believe you're going to have when you start a new business, it's important to set up that structure. There's different structures. Like one structure we try and set up all the time is you want to have a family trust in place, or even just something called like a trust sandwich, so that you can keep your business pure without actually having to pay yourself as an individual and pay that high rate of tax if you already have a salary coming from the business, let's say, right? So we use that kind of structure where we'll pay up dividends from the operating company through a trust to another holding company to keep it pure, to keep your operating company pure. And that trust will also allow you, when you do go and sell your business, it'll allow you to even multiply that capital gains exemption, where you can potentially pass those capital gains to your wife or your kids and whatnot. It'll give you that option to even look at that, for example, depending on the type of business and depending on a few nuances.
So I want to go a little bit further on there. So when I have a new client, somebody who's starting a business, and I know they're going to make money, like I already know, like
you can feel it, you can see it,
you can see it, you see the money. No, but like for example, they have the contracts lined up. They get a service-based business. Usually I'm dealing with service-based businesses. So if I know that they're going to make money, right? And I know that their family budget does not need everything that they make,
Yeah.
then that's where I start the conversation. And I usually give them a 3-tiered menu, right? Menu 1 is straight corporation. You have one corporation. What's the benefit to that? It's easy. It's cheap, right? Not a lot of legal fees, not a lot of accounting fees. You get the small business deduction. So in Ontario, that gives you a flat tax rate up to $500,000 of 12.2%, something like that, right? You take a salary for whatever it is you need for your personal living, and you retain the rest. Okay, so super tax efficient, does what you need it to do, and limits liability. However, over time, you're going to build up a lot of redundant assets. You're going to build up a stock portfolio of millions of dollars because you didn't need to pull that money out. So now we have a problem. Okay, yes, you have a limitation of liability to yourself, but if somebody were to sue the company, that stock portfolio is now something that the creditor can take.
Yeah.
All right. So step number 2, we introduce a holding company. So you have an indirect ownership of your company. You own, the holding company owns the operating company. All the profits from the operating company get sent as by means of a dividend, a tax-free dividend, up to the holding company invests some money. So now what's the benefit of that? The benefit is, well, it's not that complicated to report, a little bit more complicated to report, a little bit more accounting and legal fees, but you're protecting those retirement assets. You're segregating those retirement assets away from the operating company gets sued. You can theoretically claim bankruptcy on that operating company and nobody can touch your retirement portfolio. Okay. What's the big downside? It's exactly what you guys were saying. Because you have indirect ownership or corporate ownership of the operating company, if you go and try to sell the shares of your operating company, because nobody wants to buy your holding company, it's actually not you selling the shares. It's your holding company selling the shares of your operating company. So you cannot trigger the lifetime capital gains exemption. And that is a huge component of being a small business owner, getting that lifetime capital gains exemption. So what your solution was, Matthew, was to sandwich in a trust. So a trust is just an agreement between a trustee and beneficiaries and a settler
To keep
that the shares, in this particular case, the shares of the operating company will be owned by the trust for the benefit of mom, dad, the kids, and some random family holding company.
Exactly.
So we can recycle the money out to the holding company without having to give ourselves a dividend and paying tax of 50% and get the best of both worlds.
Yeah.
Get the tax deferral on the retirement portfolio and get the tax-free sale of the business down the road. What's the downside?
Yeah.
Cost and complexity.
Every corporation, like you mentioned, we explain to our clients, it's like a baby, right? It's like you set up a new corporation, you got to take care of that baby. You got to take care of, you got to deal with the lawyer every year. You got to deal with your accountants. You got to make sure that you're compliant or else you can turn into different issues. The setup costs of a structure versus not setting it up. Sometimes you don't want to turn that 4-figure accounting problem or accounting fee problem and lawyer fee problem into a 5-6 figure problem.
Easily.
Right? And
Easily.
The last thing you want to deal with is you have this structure, you had it forever, or that you think works, and you go and sell your business and it's boom, I'm losing out on $400,000 just like that.
Yeah.
And you don't realize it. So there's so many disadvantages to even having that holding company structure. It works for some people because there's other benefits and disadvantages that come with it, but sometimes you don't even realize it. Even having investment income in a company, if you have investment income over 50,000, between 50 to 150, like you can even lose your small business deduction without even knowing it. Right. So there's just more measures that come in place by the government to affect the wealthy or the business owner where it's like they're not aware of it, but you can be at risk from a tax situation and have ultimately tax obligations and tax penalties and interest that you're not even aware you currently have that come out into place.
And I think an important thing too is we're talking about the initial structure, but I think it's just keeping constant communication with your accountant and just always outlining what's my 5-10 year plan. Because even if you set up your initial structure setup isn't the most tax efficient for a sale, if your client comes to you and says, hey, Matt, hey, Fad, I want to sell my business, but I'm thinking about selling it in 5 years or 10 years. At least you can do planning sort of things
in advance
now to set up for that sale in 5 years. So just educating your clients on the lifetime capital gains exemption, proper planning to put in place, and just keeping that constant communication with your CPA and your accountant is critical. And that's why it goes back to our original point on the vital asset of having good business advisor, a good CPA on your team, because at the end of the day, it can save you a lot of money in the future.
Yeah, we always preach too, if they're going to go make a major business decision or they want to be a part of something, just contact us first. Give us a call. Say, hey, I'm planning on doing this. What do you think? And then sometimes you'll take a look and be like, man, why are you even doing this? It makes no sense. You know what I mean? So it's always good to even have a soundboard. And if you have a good advisor with you as partnering with you, you'd be surprised how much farther you can go just by realizing, hey, if I go down this approach, this is my tax savings. If I take this approach, I'm going to have this other tax or this liability that I'm going to have to deal with. Like, it's important to factor that in before you do something, as opposed to going and doing it and then hey, Fabio, I did all this. What do I do now? Oh man, like, you're in a tough situation there, right? Yeah. So it happens all the time.
Not everybody's going to sell their business. Not everyone's going to be able to sell their business. Let's say you're a consultant, for example, like an independent consultant. Maybe you have an assistant. You're not running a business you're running a business that is really focused on you as the knowledge base and the primary generator of revenue. So in a situation like that, it actually gets a little bit simpler, but it doesn't, right? Because of that, you brought up the point of, if you start generating investment income within your corporation or within the associated corporate group and it exceeds $150,000, you're now pushing yourself from the small business deduction rate, 12.2%, up to the general rate, so 20, 25, 26%, depending on whatever province you're in. Yeah. Okay, so let's just say 25% on average across the country, right? So this is, once again, this is a new measure, or newish measure brought in by the current government, stating that, hey, we're going to allow you as a small business owner to save $1 million, because after $1 million, you're too rich. We're going to punish you with tax. You and I, we all know that $1 million really does fuck all for you nowadays, right? You can't even buy a house for $1 million. Yeah. So what are you going to do with $1 million? Doesn't matter. They think you're rich. And it doesn't matter if you're living somewhere in, I don't know, in the outskirts of somewhere in Newfoundland where you can buy a property for a couple $100,000, or in the middle of Toronto where, a crappy little 600 square foot condo is going to cost you $800,000, $900,000. It doesn't matter. Everybody gets $1 million, and you cannot generate more than 5% return on investment on that $1 million. So if you've saved $1 million, you're a consultant, you've managed to save yourself $1 million within your corporate group, either in your holding company or in your company, your corporation, you're generating 5% return on investment. Now we're going to get a grind down of the tax, okay? And you're going to get into this area where the taxation becomes so complicated that it's impossible to explain, I can't even explain it to my staff sometimes, who are highly educated, very good finance people, right? So what I want to talk about is, we've actually been working on a couple of joint clients, and it's that integration of saving and tax planning during your lifetime, not just at the end when you want to sell the business or retire. That integration of saving and investing in a tax efficient manner, because there's multiple layers of tax, right? So I don't know, maybe you guys can explain a little bit better than me how a small business owner is taxed on their passive income.
Yeah, for sure. If you're taxed in a corporation, obviously, if you have passive investments, there's the government, like we were mentioning before, they want to tax you more heavily if you keep that excess cash in your corporation. So if you do have investments in your corporation, you're going to be paying the high rate of tax in there, which is about 50.17% that you're paying on any investment income. So let's just make it simple. If you make $1,000 net rental income from a rental property that you have in there, that's considered to be passive, you're paying 50% on it. And there's a portion of it's considered refundable. So the government keeps that, not to get too technical, but the government keeps that as like a refundable tax, that you prepaid tax that you pay in your corporation. And you can only get that out if you pay yourself a dividend to yourself as the individual.
But then you're paying 47.74% tax to get that dividend out.
Exactly. Right? They're more punitive in a sense now, where if you do have investment income in your corporation, you're paying tax at the high rate. And in order to get back that high rate of tax that you paid, that differential, you're going to have to pay yourself a dividend, which you ultimately don't want to do in the first place, because you're going to be taxed even higher. So they are penalizing it a little more. And like I said, they want to get rid of that incentive of having you to have that excess cash in your company, and they want you to push it out.
One of the things that I've been concentrating on for probably, I want to say, the last 10 years would be restructuring corporate portfolios into much more tax efficient corporate portfolios, right?
Yeah.
Property inside of a corporation has always posed a problem, not just from a tax perspective, but also from residential property, like single family homes, condos, smaller residential properties. Larger commercial properties, that the corporate structure is completely fine. It's completely normal. For the regular, everyday small business owner that just wants to get ahead, properties inside of a corporation has always posed a problem from a financing perspective, from a tax perspective, and now from the capital gains perspective, right? Stock portfolios have been pretty good inside of a corporation, especially stock portfolios that don't have a lot of foreign dividends. So if you have Canadian dividends, yeah, we can play with the refundable tax by giving a dividend out to the owner manager, and you could pretty much get tax-free money into your corporation with Canadian dividends, right? Interest-bearing securities like bonds, GICs, high-yield mortgages are just the worst thing inside of a corporation. Absolutely horrible. They're the majority of your gains. Not joking, the majority of your gains go to the government. Literally, it's like a mafia that takes more than 50% of your money away from you, right? So this is why I've started working in the insurance industry and repackaging at least the fixed income component of people's portfolios into insurance. And it blows my mind that it's not a concept that is widespread amongst the small business community. And I don't know why. Maybe it's the complexity of the structure, but the benefit overall, for at least from when I'm calculating numbers, is so I think if you're a small business owner and you have retained earnings in your corporation and you're not considering an insurance structure in your corporation to legally tax shelter your investment income, you're messed up. You're missing out.
Definitely.
Right?
Yeah.
But are you guys, I know you guys must have, how many clients do you guys have now?
Quite a bit.
Hundreds, hundreds, right? Are you seeing these structures in your clients or no?
Honestly, they're not as frequent, and it's not because it's not a good product. It's just because people don't know about it. And people,
Must be.
Yeah, people don't know. We are seeing it with our clients, or even new clients more so. It's like they have that structure that's not efficient, and they have a bunch of investment income in there, or they have investment assets that they've purchased that are from their excess cash. And it's okay, now what am I going to do with this investment income that I have that I thought was okay, but now with the new rules, it's punishing my operating business. And that's where you bring in life insurance, where life insurance is a good vehicle, that tax efficient vehicle that you can use to generate that kind of investment income and not have it be taxed as punitively in the corporation with the current system we have in place.
Right.
I think I see it a lot with the wealthier clients. I think the banks are pushing to them sort of the life insurance plan, tax plan.
Right.
From our perspective, we don't deal with sort of the investment side in our practice, so it's difficult to always be on top of that stuff. But obviously, when we have our year-end meetings with our clients and whatnot, it's something that we definitely bring to their attention. But I guess, Fab, the question that we have to you is, a lot of times we see our clients will come to us and be like, hey, one of my banks that I deal with, they're trying to sell me this life insurance policy. What do you think about it?
Yeah.
So what are some sort of things that you see from type of the product that you offer in your practice as opposed to what the banks offer?
Yeah. And just who's an ideal candidate for a life insurance? What kind of structure and like what kind of individual is like an ideal candidate for a life insurance kind of policy?
I'll break it down for you. So small business owners who are incorporated, who have retained earnings in their corporation, a lot of retained earnings in their corporation at almost any age are a candidate, okay? Or small business owners who have strong earnings. So doctors, dentists, engineers, consultants that have strong future earnings that may be a little bit younger, that don't have a lot of built up retained earnings in their corporation. Both those groups are definitely good candidates for this type of a structure. And the structure is complicated, but also very easy to break down, okay? And it's very simple. Your corporation or your holding corporation is a person under the law. And that person is going to be up shit's creek if you die, okay? Your business is not going to be able to continue. There's going to be taxes at your death. There's going to be a lot of bad things that happen when you die. Therefore, that corporation has an interest in your life. And legally, that corporation can take an insurance policy on your life as the owner manager of the business. So what you can do legally under current tax legislation, and I just don't see how this will really change materially over time, you can create a permanent life insurance policy. So there's a difference between a term life insurance policy and permanent. So for those who don't understand insurance very much, term life insurance is it's like car insurance. It covers your risk of death while you're paying for it. Then when you stop paying for it, or when you cancel it, or when the term is over, it expires, worthless. You don't get anything out of it. Permanent insurance, on the other hand, is a form of, it's an asset that you own. You pay for it. It can have a starting and ending payment date, 10 years, 20 years, whatever it may be, or it can go on forever. You pay for it until the day you die. But it gives you a defined benefit at the end. You will get, no matter when you die, you will get that death benefit, or your corporation will get that death benefit. The interesting component of that is that depending on how high that death benefit is, the government allows you under current tax legislation to overfund that policy into an investment account. And the beautiful thing about that investment account is it's a tax-free, when it's structured properly and within certain limits, it's a tax-free investment account. So what you're able to do here is you're able to create essentially almost a limitless, very large TFSA style of investment vehicle inside of your corporation. All right. So you take your retained earnings that have already been taxed at 12.2%, you dump it into this insurance policy, overfund the policy significantly so that you have a large cash value sitting in the policy. That cash value is an investment portfolio. There are many different types of products out there. There's some that you can pick and choose your investments, and there are others that I prefer, which are usually whole life policies where you don't pick and choose. You just participate in the general pool of investments. Okay. There's a multitude of different benefits that you're going to get from that other than tax. But from a pure tax perspective, every year, if let's say you're in a participating whole life insurance policy, that pool of investments will pay you a dividend. The dividend will come and reinvest into the policy, increasing your death benefit, increasing your cash surrender value. You don't have to report that on your corporate tax return. So it's not even something that is considered as taxable income. And the compound effect of that over time is what really where the magic comes from. So these particular products, they don't pay a huge return on investment. So let's say most of the major insurance companies are paying somewhere in the 6% ROI right now. Okay.
Does that factor in the tax savings that you have though? That 6%, the 6%.
No, that's the pure ROI, right? But when you look at it from, let's say it's even a 5% ROI that you actually achieve on this thing. When you look at it from a tax perspective, depending on your actual marginal tax rate on the outside of the corporation, but within the corporation, it's 50%, right? So a 5% rate of return is really a 10% rate of return.
Exactly.
And then the way that these things work is as soon as with the participating whole life policies, is as soon as you receive the dividend and it's reinvested, it's pretty much vested. It doesn't go negative. So it creeps up like a GIC, right? So in the end, because of the tax play here, because you're creating a legal tax shelter within the corporation, you're creating this TFSA within the corporation, you're getting a huge bump up over time because of the fact that you're not negative compounding because of tax. Then once you are structuring these things properly, they're very tax efficient at death, right? And they're also very liquid. You're also able to pull money out of them after you've built up a certain amount of assets within them, and you can pull that money out in a number of ways, some of which are actually tax-free.
Can you pull it out personally? Okay.
You can.
There's ways you can do it,
It's much more
right?
complicated to do that. You actually have to, it's very complicated. You have to actually pay your corporation.
I know you mentioned there's nuances to it.
There's nuances to it. So generally speaking, there's 3 ways you can pull money out of a whole life insurance policy, right? The first would be to surrender some of it, partial or full surrender, meaning that you say, hey, listen, I've got $1 million of cash value in this policy. I want 100 grand. Give me 100 grand. That means you've surrendered that policy. that could be a taxable event. If the fair market value of the policy exceeds the adjusted cost base, you're taxed on that excess. Okay. The second downside to doing that is you actually reduce the size of the policy. You reduce your death benefit and you reduce the cash value. So your future dividends are lower and your future death benefit to your beneficiaries is lower.
And that death benefit is tax free, right? When you pay
The death benefit comes tax free.
Yeah.
Okay. So that's way number one. We don't like to do that. The second way, if you need some quick cash, is you can obtain a policy loan. You just go to the insurer and say, I want to borrow some money. That's going to be you're going to be borrowing. It's quick. It's like a secured line of credit pretty much. And you're literally borrowing from yourself. So a lot of like that infinite banking stuff, that's how it used to be done, I believe. The problem with that is they've changed the tax legislation a number of years ago. And essentially that is akin to a surrender from a tax perspective, meaning that you can trigger a gain. So you can get the money quick, you trigger a gain, right? But if you pay it back, you can reverse.
Got it.
Right? It's a good way to get some quick money if you need quick money. But the interest rates are generally high. Okay. The third way, and in my opinion, the best way to do this is once you've built up enough money in the cash value component of your policy, is to post that policy as collateral for a loan or a series of loans. Okay. So you can do something called an IFA or an immediate financing arrangement where they will underwrite up to 10 years usually of loans, annual loans for you. Or you can just say, give me a margin secured line of credit against this thing. So let's say you've got $1 million of cash value sitting in your policy and you want to access $800,000 of that quick. So 80% loan to value. Very easy. Very simple. Make an application, pay a couple $100, do a credit check, boom, you get your money and you can draw it when you want, pay it back when you want. It's open and it's usually the interest rate will be like prime rate plus a spread of maximum 1%.
And there's no tax implication on that.
There's no tax. There's actually tax benefits. So if you're doing this within the corporation and you need the money, let's say you have a big insurance policy and you're like, hey, Fab, I need to build an office and I don't want to get a $500,000 mortgage from the bank, but I need to build it out, whatever. I need $500,000. Sure, let's get the line of credit, draw as you need to do the construction, right? And then if it's structured properly, you're able to write off the interest on that loan because you've reinvested it in your business. But B, you also get something called a collateral insurance deduction, right? So you can actually take a portion of your insurance payment as a deduction, a tax deduction.
Of the premiums, yeah.
Right? And at the same time, you haven't actually touched the portfolio. So the portfolio remains. You haven't changed your death benefit. You haven't changed your cash surrender value. You're still getting the same amount of dividends every year, and the dividends are still tax-free because they're reinvesting into the portfolio, right? So that is of the three ways to access the cash inside of a corporate life insurance policy or for a personal life insurance policy for that matter. That is the best way. It's the most tax efficient, the easiest, most flexible way to access the cash.
No, that's a good point because when we have clients that ask about life insurance and whatnot, they're uneasy about dumping a lot of money into life insurance because they're not sure if they'll need that money ever again. So they, let's say, invest and whatnot. 100%. But it's good to know that if they, even though they build up this big cash surrender value or this big life and they've dumped a lot of premiums into it, they can still borrow against it and use it for their business, even though they have it sitting in their portfolio, let's say. Right. So it's good to know.
And to address your question, Mark, specifically, the issue I'm seeing with the banks, okay, the banks are very, and I worked at a bank, okay? So the banks are very departmental. They like to say that they're integrated, but they're really not. Okay, so I don't know how the banks are selling insurance because technically they're not supposed to be, but they brand an insurance arm, let's say, and they'll bring in an insurance advisor who really knows insurance, but isn't necessarily an investment advisor and is definitely not an accountant and is definitely not a lawyer. So they're not really integrating these things, right? So they're looking to sell an insurance policy and get a big fat commission, which is fine. Everybody's got to get paid. There's nothing wrong with wanting to generate a commission, but they're not looking at the overall picture. for the particular client. And in many cases, I'm consulted after a bank has made, or a bank sponsored insurance broker or insurance advisor has made a proposal to the client, and I'm able to trim it down. Usually it's, hey, let's trim it down, right? No, you don't have to put 250 grand a year in, right? We can actually layer this so that you have the option to put 250 grand in, but you really only have to put 100. So I'm trimming it down. Maybe I'm doing a reorg on the way that the policy is structured. I often see policies thrown direct into an operating company, which I don't like, because as you build up that asset, now that asset it can actually be
liability.
taken. It's a lot. Yeah. It can be taken in a lawsuit.
Yeah.
So I might restructure to a holding company. So I'm thinking that when I see these things, it's more, they're just concentrating on placing the product.
Yeah.
And they're not thinking about the overall financial plan. They're not thinking about the overall structure that the client is going through right now. They're not taking that time to figure it out, or maybe they don't have the knowledge to figure. I don't know what it is, but
So
whatever it is,
that's where that's where you come into play. You have that experience with being a CPA and dealing with this stuff, right? Where it's a lot of life insurance advisors, they might not have that tax and accounting experience to see how that life insurance can play in their overall operating structure. So it's like a life insurance advisor might say, hey, you should just get life insurance. And they might not look at your overall business structure that you have, or how you can intertwine it, or do a tax reorg and put that into place where it's more tax efficient for yourself, right?
So this is very interesting, because I think a major benefit of talking about this is to educate the sole practitioner or the general practitioner, right? Like, Fabio, your firm, you deal with life insurance, but you also have an accounting practice. So there's synergies there in terms of, you do your year-end meetings, you have an insurance arm that you're able to offer the service. At our firm, we work very closely with you, so we have the benefit of being educated on this. But what is something that the general practitioner or sole practitioner can do or look for when they have their year-end meetings with their clients? They sit down and they go through their financials, their corporations. How can they bring this up? What should they look for? How do they start this discussion? And then what's the next steps after that?
The big thing so when a GP, an accountant, and I'm going to be very frank, right? Think back to our education when you became a CPA, and it's the same thing with doctors, right? Doctors people go to their doctor all the time, and they're looking for nutrition advice, let's say. And doctors, for all their education, have a very minute amount of education or training in nutrition. It's the same thing with the CPA. The CPA, like we said at the beginning of our conversation, is generally the most trusted advisor and the most frequently contacted advisor that a small business owner is going to have. And if you look at our education and our training, we have very little training in personal finance. Now let's flip it over to the personal finance industry. The personal finance industry is a complete farce for the most part, okay? There are a ton of personal finance individuals, financial planners, whatever you want to call them, that are very good. There's a ton out there, but there are also a ton out there that are very bad. And what it's become, or what it has always been, is a sales position, right? So the GP has to have their guard up when they're talking to their client and understand that most financial advisors are looking to close deals and sell products. That's what they're trying to do. They don't care about giving overall financial advice. That's not what they're compensated to do. So that's number one. Number two is the general practitioner, when doing a year-end meeting or when talking to the small business owner, they have to look for opportunities or for potential errors in the structure for their client. So the big opportunities are going to be, okay, we've now entered into a phase for this particular entrepreneur where, you now have steady earnings and very predictable earnings. Okay, that's a good opportunity, right? The risk area is going to be, let's say you have someone who's, I don't know, a realtor or a commissioned salesperson type of entrepreneur, where they fluctuate in their earnings. Okay, that's going to be a risk. But overall, you're looking for people that have begun to amass redundant assets or cash
And wealth, yeah.
in their corporate group or within their corporation, or have potential for strong earnings moving forward. those are the people that are going to benefit from this type of a structure, because this type of a structure, you have to put money in systematically. Okay. Then from the flip side, the risk side, where the GP can give some value add, is say, hey, listen, yeah, you had a good year this year. You sold a lot of properties, you're a realtor, or closed a lot of deals, and you've got all this cash in. Let's calm it down before an insurance advisor, an investment advisor locks you into something that you're not going to be able to write that check down the road. So it's really, you want to educate yourself on what these other people are doing, whether it's lawyers, financial advisors, whoever. You want to educate what it is they're doing, how are they compensated, what is their motivation, what is their motivation to place a product or to place a structure together, and what are the risks to the client? Because sometimes the client is only seeing the benefit, and they're
blindsided by it.
They're blindsided by it. When the shit hits the fan, that's when they start seeing the downside. You've got to be that neutral person that looks at it and says, you know what, maybe not, or you know what, yeah, now it's time. Come to this guy who's going to take care of you, and he's going to let me criticize, or she, whatever.
Yeah. Life insurance, would you say it's like an estate planning tool in a sense too, right? But
it is. First and foremost an estate planning tool.
Yeah.
And then secondarily, it's an investment tool.
Exactly. But I mean, like when it's never really too early to start looking at estate planning. We talk about it all the time, where it's like, oh, you're dealing with a 35-year-old or a 40-year-old. Like, it's never too early to really look at estate planning, because you always want to have that structure set up where later on down the road, you don't have to, if you have it set up properly, you don't got to worry too much about your estate plan, because you already have it in place. You can just documenting your wills and whatnot. There's just so much you can do in advance that you should have in place, God forbid anything happens, or even just to have your structure properly set up for your next of kin or somebody else to come into play and just take it over, right? That's one thing too. And then, like, we always joke around too, it's as a CPA, you're like a quarterback, right? So it's like you're always, there's a bunch of different avenues you can go down, and there's a bunch of different plays going on. It's like, you can hand it off to your running back, you can throw it to your wide receiver. It's like, you got to think about what's the best play at that time, and kind of what do I do, and how do I help like my team overall make sure that you're guiding them in the right way. You know what I mean?
So I think an important thing is that, and it's inevitable, no one wants to talk about death, obviously. And it's obviously a touchy subject to bring up with clients, but you have to educate them on the death tax, because you wouldn't believe, and you've seen it, we've seen it, and you've probably seen it much more than we have, because you've been at this longer than we have. But at the same time, you have so many wealthy clients who don't plan for the death tax, and they don't want to talk about it, and it's a big problem. Why is it a big problem? Because we briefly touched on it earlier in the podcast. When you die, the value of those shares that you own are taxed, and who's going to have to pay that tax? Now you leave it to your family members. So wouldn't you not rather set yourself up properly, so that when the day does come and you do pass away, at least you know your family's taken care of, and they're not hit with these large tax bills with stress. If you own a lot of real estate, you have to sell off your real estate fire sale, right? So would you say it's a critical sort of discussion to have with your clients, but also it's a touchy one too?
It's touchy, but you just got to talk about it, right?
Yeah.
And you can set it up, like you can literally set it up in your 30s.
Yeah.
And just,
it's not too early.
Just tweak it for the rest of your life. And that's all, you know. And the earlier you set it up, the better. The earlier, especially when it comes to life insurance, the earlier you set it up, the cheaper it is.
Premiums are,
and it grows over time.
Yeah.
So the premiums are much, much better.
Yeah. Well,
earlier on in life.
Yeah. We see it with our clients. Like, we see it with our clients all the time. It's like they almost don't even understand the fact where it's like you've built up all this wealth over time, and then just because it's sitting in your corporation and you didn't pay it out to yourself to pay taxes on it and take that money out personally, somebody's going to have to pay. And they don't really understand how that works. So it's like you have $10 million built up in a company, and it's just sitting there in your retained earnings. And now when you pass away, it's like that share's got to get passed to someone, and there's a deemed disposition on death. And when I say deemed disposition on death, it means those shares that you own, as soon as you pass away, that gets taxed at the fair market value that it's worth at your death. And when it's taxed, and then we brought up before the increase in the capital gains rate. So if you got that $10 million worth of shares and you bought them for nothing because it's just you capitalized the company, now you're going to have to pay 2/3 capital gains tax on the transition of that wealth to your next of kin.
So it's a good point, because let's say you just have a bunch of cash sitting in your corporation, or equity stocks, liquid investments that you can easily dispose, pay the tax, and you can move on. But now, we're obviously in Canada, real estate is one of the biggest industries, if not the biggest. And you have a bunch of clients, Fab, which you've probably seen now, they're sitting on all this real estate in their corporation. So what happens now when you pass away? the fair market value of your shares is going to be directly correlated to the fair market value
The real estate.
of that real estate. And it's like, how do you just go sell, let's say you own a commercial building or an apartment building, plaza, a bunch of rental properties. How do you just go have a fire sale? You know what I mean? And then now it's like, you're going to have to sell these pieces of real estate at a reduced value. And it could just be a snowball of bad things.
Yeah. And maybe your plan was, okay, I'm going to build this plaza and I'm going to pass it on to my kids and they're going to be able to operate this for the rest of their lives. And it's going to be a lot of income or just a way for them to have a livelihood. And then you realize, oh, okay, I've built this up, but now I got to pay the tax. So what do? Do I take out a loan?
This is one of the number one things that people approach me about, right? It's, okay, I built up this portfolio of properties, 10 properties, 12 properties, 15 properties, whatever the heck it is, right? How do I pass these on to my kids? There's a lot of questions here. Do your kids even fucking want them?
That's number one. Yes.
Do they want to operate? They got too much money.
Because do they actually want them? That's number one. Or what happens if you have 3 kids, 2 kids want properties, 1 kid wants, right? But all the properties are good and you don't want to sell any of them, right? So as you build wealth in Canada, you're going to be attacked on a number of different fronts. You're going to have a number of problems. You're going to have tax problems, that's for sure. You're going to have legal problems, family law, people trying to sue you, that sort of stuff, 150%. You're going to have problems with the volatility of your investments. They go up, they go down, they go up, they go down. Real estate doesn't always go up. It goes up, it goes down, it goes up, it goes down. Stocks, you look at the stock market, you might as well be on a roller coaster, right? They go up and they go down. And you're going to have liquidity problems, right? So real estate is a very powerful tool to build wealth. A lot of people have built a lot of wealth with real estate. There's a bunch of different groups and podcasts and shows all about real estate. Great asset class, okay? But it's hyper illiquid. And when you need the money the most, AKA when you die, your estate needs the money the most, you're not going to be able to liquidate any of them. It's very slow to liquidate. And when you want to liquidate fast, you're going to get ripped off. Okay? Stocks, very liquid, press a button, sell. But what happens if you die at the same time the market dropped 30%, right? So this is where something like a product like life insurance comes into play because you can pretty much bank on what you're going to get at the end, right? Plus minus a couple percentage points, right? You can bank on that and it's hyper liquid. It's hyper liquid, right? As soon as you die, you send the death certificate to the insurance company, you get a check. It's all cash. You do whatever you need to do, pay estate taxes, pay lawyers, pay accountants, cut a check to the kid that doesn't want properties to equalize your estate with the kids that do want the properties, right? So it's a very good tool in the estate planning toolkit. But the point I'm trying to make that about, let's say, the banks or let's say a lot of like life insurance centric planners is it's just a tool in the toolkit. It's not the toolkit. Do you get what I'm saying?
Yeah.
So you got to see how it fits.
You got to work with your team.
You got to see how it fits in.
Yeah. Because even it's an estate planning tool, like you mentioned, but you plan your life insurance ultimate death benefit based on what your death tax is going to be. So when you're going and doing this whole reorg, that's where life insurance is a great time to look into life insurance. Because if you're going to do like an estate freeze, for example, on father who wants to pass the wealth on just to say, I don't know, to son, if father freezes his value and does like an estate freeze and maybe say he's worth 10 million and he needs, I don't know, just call it 2.5 million of tax, then you can go set up a life insurance policy with a death benefit of $2.5 million
and clear it out.
Bob's your uncle. Your son doesn't even have to deal with
clear it out
with the issue of having to pay tax at the end of the day. Because listen, at the end of the day, it's just money. Like you can't take that money with you when you die. But the last thing you want to do is leave these issues with your family, and your family has to figure out, oh, my father set up all this, but all of his affairs were not even put in order at all, and now you have to pay all this tax. And it's now I'm fighting with my sister. It's, hey, I want to sell this, but you don't want to sell it. Then it's like you're splitting up the family, and for what? So you lived your whole life, you built all this wealth, passed it down to your kids, and now your kids don't even talk to each other anymore. So that's the main thing. You want to just make sure your family planning is done while you do your estate planning, while you look at your life insurance, while you take a look at what your death tax is going to be. You got to factor all that in, and it's better to do it early, like you said.
And an important thing too, as this sort of the general practitioner, sole practitioner, is knowing your limits, right? Because we get clients come to us all the time and say, okay, you know, at my investment advisor, they're trying to offer me a life insurance plan and whatnot, and they bring it to us and say, what do you think about it? And I'm the first to say, I know what I don't know. So I would say, you know, let me loop in a trusted advisor of my own, which would be Fabio. he can come in, he can look at the plan, well, obviously with your consent, look at the plan and advise, because I'm not in a position to sit there and be like, yeah, this is good, this is not
go
good.
ahead.
I can speak from an accounting perspective. Matt can speak from a tax perspective, no problem. The actual policy being offered, you have to know your limits.
Yeah.
So just being able to know your options as a general practitioner, sole practitioner, and just understanding that there are people who specialize in this stuff who maybe have a whole toolkit of experience when dealing with this.
And that's a good point too, where you bring up like the whole stigma of a general practitioner or a small firm. Like we're a smaller firm, but we operate it more like a mid-sized to big-sized firm because we have like different hats, for example. So like Marc will focus on the assurance side of the business, right? I'll focus on the tax and estate planning part. Our other part, and Luca will focus on like the accounting and advisory. So it's like we each have our own hat, and it's okay. I'm working with Marc on something, and he's like, hey, so-and-so has to go get a review engagement now, and he needs this loan. And it's like, maybe we should look at some tax planning to do for him. Or, hey, he built up all this CDA in his capital dividend account. Can you take care of it? I don't know what to do. And that's where we have that ability to grow with our clients as they grow and as they need more niche services like a life insurance policy. Like we're able to help them get the product they need and set up their ultimate like estate succession plan and have that all set up and up to date where they're not having any leakage areas of tax where at the end of the day you go take a look and it's, oh man, I amassed all this wealth in my life and now I got to pay an extra $5 million of tax that I didn't expect to pay. And if I had just set it up from the beginning and paid my, I don't know, $5,000, $10,000, $50,000 to set it up properly, I wouldn't have to pay $5 million tax, right? So it's like I was saying before, don't let that 4-figure, 5-figure issue turn into a seven-figure issue. Right. So that's a good point that you mentioned.
So this is a good segue because one of the next guests is going to be an estate lawyer. So we can continue that conversation there in a more legal perspective. But guys, thank you for coming.
Thanks for having us.
Thank you.
This is a very nice setup you have here. I enjoyed it.
All right.